Hey, welcome back to another video here in FiscalVoyage. My name is Felix. The market is at an all-time high today. It's up over 0.5%. I saw at one point almost 0.7% increase today. Even though the market is at an all-time high, is there still buying opportunity? Should we be buying or waiting for a crash in this time for the market? And in this video, we're going to look at 5 different companies that looks to be undervalued that I think you guys will find very attractive while you do your own research. These 5 companies are high quality, investment grade companies, solid dividend history, and as well as potential of 15, 20, even 30% total rate of return for the next few years. So let's go over these 5 different companies. The market is at an all-time high, but it still presents good buying opportunities with different pockets of different companies. If you're new to the channel, make sure to hit that subscribe button, and if you like to make money, hit that like button. So let's get started with these 5 stocks. Alright, so first let's look at the Dow Jones Industrial Average. You can see right now it's $30,142.52. It's actually up 0.5%, 0.6% for today. So it is obviously at the all-time high right now. 52-week high is at 30,046, so it's over that with today's market, up $170. And if we look at the S&P 500, it's kind of the same stories there. If we go here, S&P 500 5-year chart, right now S&P 500 is going for $3690 and 38 cents, up almost 0.7%. And you can see here again, it's slightly lower than the 52-week range, but it's basically right there. So with the market being at all-time highs, should you be investing now or holding, waiting for a crash? So if we look at the fast graph for the S&P, you can see here, first off, the S&P has been growing earnings very nicely throughout the years. Again, they had a recession in 2000. It lost 31% of earnings, and in 2008, 2009, it dropped 17% and 16% in earnings, and then this year is expected to drop about 18% in earnings, but picking up very nicely, 25% and 16% for 2021 and 2022. And if we put the price chart here, you can see right now the S&P 500 has a PE ratio of 27. This is based on yesterday's closing price, so it's actually a little higher today. So based on yesterday's closing price, we have a PE of 27. This is based on this expected earnings. Obviously, with next year, it should be around a PE around 22 maybe, or a high 20 to 25 range. But if we were to check the projected annual rate of return, we could see we could have a total annual rate of return of negative 2.4% for the next few years. So that's not very compelling and attractive. That I don't like to see that at all. I think the market looks to be overvalued, but just because the market is overvalued doesn't mean you can't find undervalued, high quality company in this market. There's a whole bunch of that, and in this video I'm going to show you a few of those stocks. So let's continue. The first one I want to talk about is Lockheed Martin, and Lockheed Martin looks to be very attractive right now. It has a PE around 14.8, and if we shorten this time period here, you can see if the company will revert back to its mean, you have a projected total annual rate of return of 19%, much better than that negative 2% for the next few years. And you can see here is whenever it got to about a PE of 15 or lower, it bounced back. It never really stays at that PE. Like the average you see here is around 18. So right now here is under 15 PE. It did that in 2018, the end of 2018. You can see here at a 14.9 PE, and it jumped very nicely until before the economic shutdown. It had a 63% return basically in that period. But because of the economic shutdown and all the things going on right now, it presents us a good, attractive buying opportunity. And again, if we revert back to the mean around 18, you have a 20% annual rate of return. The company is a very solid company, Lockheed Martin, negative A minus credit rating, which is investment grade, high quality. Long-term debt to cap is at 66%. It is higher than the 50% ratio that I like, but it's still manageable. The dividend looks attractive, 2.87, and the earnings yield at 6.72. So that's attractive earnings yield. So overall, Lockheed Martin looks like a good buying opportunity in today's price, even with the market being overvalued. Another company I like to look at is Bristol Myers Squibb. Bristol Myers Squibb, I talked about this company as well as Lockheed Martin before. Bristol Myers Squibb looks very attractive based on the fast graph. If we shorten this time period, you can see here they've been, in the past few years, they've been growing earnings very nicely, and they're expected to continue that for the next few years. So you can see here in 2018 they grew earnings at 32%, and in 2019 18%, and this year they're expected to grow earnings at 36%. Even with the other things that's going on this year, they're still able to grow earnings not only higher than last year, but 36% greater than last year. So that's outstanding. And in 2021, they're expected to be 17% greater. And if the company, for whatever reason, goes back to a multiple around 23, which I think is pretty high multiple, you have an annual rate of return of about 71%. That's crazy rate of return in a few years. But if we're conservative and look at a multiple around 17, still very attractive valuation. Eventually the market is going to see this, and actually Warren Buffett actually bought shares of this company, so he sees the undervaluation of this company. So that's very attractive. A plus credit rating, investment grade, low long-term debt to cap ratio, the yield almost 3%, earnings yield at 10%, very attractive company. I've been buying this company. If you follow, subscribe to my channel, you've seen I've made videos of this company. It's been kind of flat since those videos, but it just gives us more and more opportunities to continue building our position there for Bristol Myers Squibb. So it looks very attractive. So, you guys should definitely look into this stock. The next company I want to look at is MRK for Merck. Was it Merck? Merck and Co. Actually, Buffett as well bought shares of this company, and I've made videos of this company as well, and it's been slightly on the uptrend right now, but you can see here it's been very solid company, earnings growing year after year. It's been a few years where it's been negative. You can see here in 2003, 2004, as well as 2013, but overall is an uptrend. If we shorten this time period, you can see the company it's undervalued with a PE around 13 or 14, and if we revert back to a PE around 15, you can still have a nice annual rate of return of 15.6 for the next few years while you're collecting a dividend over 3%. So very attractive dividend. Earnings yield of 7.26. So Merck, I've made video again of this video. I own shares of this company, and it looks at a good buying opportunity. Again, the market is at all-time highs. It still presents good buying opportunities with different companies, different pockets of company that are attractive right now. So let's go look at the next one, Cigna. Cigna actually meets the rule number 1 investing requirement, which I'm going to show you here shortly. So Cigna here, I went to Morningstar and look at the key ratios. You can see here all the 10 years information. So what I did is copy this information into my spreadsheet. You can download the spreadsheet in the link below, which is rule number 1, the big 5, investing. So what I did is just copy the revenue into this here, earnings per share, the book value, equity growth, the free cash flow growth, and it puts it in here. And you can see when this is all green, that means it meets the rule number 1 requirement of 10% or higher for the 10-year, 5-year, and 1 year. So obviously it looks very good here, so it beats that. So if we go to fast graph, you can see here Cigna looks undervalued. If we go to the history, it could give you about a 14% annual rate of return. And if we shorten this time period, it actually gives you a better, because this gives you a more recent growth of the company. And you can see here, it gives you 24%, almost 25% annual rate of return for the next few years. So very attractive. Earnings yield at 8.66. S&P credit rating of A- with investment grade, low long-term debt to cap ratio. So this is a high quality company at a fairly to undervalued price. And the fact that it meets the rule number 1 investing, it makes it even more attractive in my opinion. You can see here, sales been growing year over year is 216%. The 5-year, 41% revenue growth. outstanding. The return on investment capital, 16, 14%, 10%. So that's attractive as well. You know, it's in a downtrend, but still it meets that rule number one investing criteria. Equity or book value per share has been growing outstanding. You can see here. So overall, Cigna looks very attractive price. I actually bought shares around $205, I think it is, my cost basis. So I'm up very nice so far, and I'm very excited about this company. So you guys should definitely look into Cigna, ticker symbol CI. So again, these are good, high quality company at a overvalued market. So again, even because the market is overvalued, you can still find pockets of different companies that are undervalued. Like I mentioned, Lockheed Martin, Merck, Bristol, Meyer, Squibb, and Cigna. So these companies are undervalued companies that present great buying opportunities. And personally, I've been buying them, and I think you guys should definitely research these companies and let me know in the comments, what's your thoughts of these companies, and also let me know what other companies you think are undervalued. And the last company I want to talk about is Atari Group. You can see here, earnings been outstanding. It's been growing every year, even through the financial crisis. It grew 8% in 2000. In 2001, 22%, 2008, 6%, 2009. So it just didn't even phase through the financial crisis. And then this year is growing, expected to grow earnings about 4%. So the economic shutdown and all the things going on, it has not affected this company at all. But what did affect the company is the price. And the price is very undervalued. If you see here, based on the fast graph, if the company will revert back to its mean of around 17 PE, you can have 50% annual rate of return in the next few years if it will revert back to the mean. And while you're waiting, you're collecting 8.5% dividend yield. Outstanding. Earnings yield at 10.8, very attractive. Triple B credit rating, so it's investment grade. They do have pretty high long-term debt to cap ratio, but overall, they do have a lot of free cash flow. So that's very positive for this company. So again, another company that looks undervalued in this overvalued market. There you have it, guys. I presented you 5 different companies, and there's still a lot more that I've done in previous videos. So make sure to subscribe to the channel so we could find more undervalued companies. But these 5 undervalued companies presents good buying opportunities. Some of them are even great. But check out them, do your research on them. I think they present good buying opportunity in this overvalued market. Again, you could download the rule number 1 investing spreadsheet in the description below, as well as my free ebook in the description below using that same link. So make sure to check that out down below. Again, if you're new to the channel, make sure to hit that subscribe button and like this video if you enjoyed it, and I'll see you guys in the next one.